Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided is general in nature and does not take into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider whether it is appropriate for your circumstances and seek professional advice from a licensed financial advisor. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. It is based on our understanding of regulations and laws as at the publication date. As these are subject to change, you should talk to a professional advisor for the most up-to-date information. Any examples or illustrations provided are for illustrative purposes only and are not a guarantee of future performance. We do not accept any liability for any loss or damage incurred by reliance on the information provided. Any opinions expressed are subject to change without notice. Past performance is not indicative of future results, and all investments carry risks. Neither the hosts, guests, nor any affiliated entities accept liability for any loss or damage arising from reliance on the information provided. By listening to this podcast and viewing this presentation, you acknowledge and agree to these terms.
Good morning, everyone. Welcome to another episode of Wealth Coffee Chats on the Thursday, where we talk all things financial planning. You can see a different environment today. I'm actually in the office seeing a few clients for the start of the year, just to make sure that we set up their strategies now and not on the 30th of June when nothing can be done. So let's dive into today's topic. So we all know what happened during the week. We got an interest rate rise. So as you know, I usually try to keep you guys up to date in that regard, and I want to take you through what they've said, what are we looking for, and what are the indications moving forward. And then we'll sort of summarize what does that mean for everyone and their asset classes, what impact does the interest rate rise has on you. So I've got Pat online. Welcome, Pat. Good to see you, mate. We'll be catching up with you next week. We've got Kobe Wiggle saying hi to Pat. Well done. Awesome, guys. So let's look into it. So before I jump in and share my screen, so we all know the interest rates ticked up 25 basis points on Tuesday. So we'll dive into it and see what the causes behind that. So as always, you can find all this information on the RBA website, but it's typically a very short version. I encourage everyone to read through it, and you'll see that there's a little information as to what the RBA is thinking. So, as I mentioned, they increased the interest rates by 25 basis points. So now we're sitting at 3.85%, right? So it's probably been the shortest rate cut period in a little while. So, it came as a surprise, but also we'll get into the reasons as to why it happened. So, in fact, actually, just looking at it, so yeah, they cited inflation, but really they're talking about the second half of 2025 and the expenses that creeped up around there. As I mentioned in the past, you would have heard me say that in October last year, the electricity rebates came to an end, so that forms part of those inflation figures, and ultimately, we expected this that it would increase their numbers because, again, what's the purpose of the RBA? It's to keep the inflation rate between 2 and 3%. Currently, it's sitting at around 3.8, so way above where it should be. You might ask, oh, well, it's been sitting above 3% for a little while now, and you are correct. But at that point in time, the unemployment rate was actually sitting a little bit higher than expected as well. So those two metrics were actually offsetting each other. But as you will see in a second, they're citing that the unemployment rate is now coming down slightly, which now gives the RBA no real reason not to hike the rates. So we are the first sort of nation globally to increase the rates. But if you look elsewhere, the US, UK, they're all looking to reduce their rates as soon as possible, even though the US held their rates during the week. So what are they citing for all the pickup in expenses? So they're talking about household and spending and investments. They're citing that the prices of the housing and activities has been strong. We know that, you look at Queensland, South Australia, Perth, the housing there has been like literally on fire in terms of pricing. So, Melbourne is now down the list as the most affordable city. I think it's either last or second last on that list, which is quite amazing to think about, given we are probably the second biggest city behind Sydney in Australia. There were obviously, when the interest rates were lower, that's great for the businesses, that's great for consumer confidence. You go out, you spend the money that you would have saved from the previous rate cuts would have gone into the economy. So again, that is all multiplying and impacting the. So oh, here we go. We're back on here. So what do we got? So they're talking about strong markets. They're talking about a couple of things outside of the norm, which we don't typically see. They're talking about money market interest rates and government bond yields have risen following a rise in the market expectations for the cash rate. So if you don't know, this is a separate topic that I'll probably bring to you guys a little bit later in the year, but something to look at, and that is the Japanese yen and then the interest rates there. So that impacts everyone. So I'm not going to go into too much detail, but this is what they're kind of alluding to as part of it, but not directly, but indirectly. So then, like I mentioned earlier, talking about the labor market, they're talking about the unemployment rate being lower than expected. So that's a change from September last year, where the unemployment rate ticked up and then it dropped. So the numbers behind this metric is a little bit flaky. So we'll see what the next set of numbers come out as, and that we might see where will that take us. So again, very similar narrative and context from the previous meetings. The uncertainty around domestic, international economies, inflation, And I guess an interesting thing that they're saying here is that they're saying if growth in demand is stronger than expected and growth in the economy's supply capacity remains limited, it is likely to add further capacity pressures. So they're using capacity pressures words here very sneakily, because if you go back to the original part of it, that I didn't highlight it, but they're talking about capacity pressures reflect blah blah blah, and they go into the details as to what that is, which is all the inflationary aspects that contributed to their decision to increase the rate. So what this statement is, and I highlighted it here, it's basically giving them the right to further increase rates, right? So this 2026 will be a very interesting year, because if the economy continues to stay strong and we don't have any sort of crazy market volatility, then you'd probably be preparing yourself for another rate rise, maybe two, so that the inflation does get squeezed down and brought in line with expectations. And that expectation again is between 2 and 3%. There's been a lot of talk about trying to refine the 2 to 3% inflation rate and maybe keep it more around 3 to 4%, but that's probably a longer conversation. So largely 2025, too many consistent inflation spikes above 3%. So now they're pulling the trigger to get this to increase the rates. And they're talking about the inflation. They're expecting it to continue where it is currently. So they're not expecting that this rate will actually do too much, but they're wanting to see a slowdown. They don't want to see anything, any sort of further inflationary pressures from their decision. So what does that mean for you as an investor, and in terms of different asset classes? So we talked about that in the past, but really cash probably the winner out of this, because you can go to a bank, get a term deposit, get a higher interest rate. Bonds, you would think that it's it is a defensive asset, and you think that would be quite good for them from a higher rates, but in fact bonds actually, the capital value of the bond drops as soon as the interest rate rises, and it doesn't reverse. So if the interest rate drops, then the value of that bond goes up. Just a very easy analogy: why would I buy your bond at 3.5% when I can go and buy a bond for 3.85% now, right? So therefore the value or capital value of that drops. Property, again, probably high interest rates, so there might be a little bit of a squeeze on lending. So I would encourage everyone, if you are in the middle of applying or looking to buy something, just speak to your broker, double check that the numbers are still working for you, especially if you're in a bit of a tight sort of situation, because you might need to perhaps add a little bit extra in terms of your deposit, right? So, but speak to your broker. With the equities market, typically the initial expectation is that it's going to put a bit of a downwards pressure on the equities, especially in the more lower value stocks, because of how they get priced and the future pricing, etc. So you get repriced, and they tend to fall in value in the short term. The bigger guys, they don't really get impacted. In fact, someone like the banking sector, that's a good thing for them. That means a little bit extra that they can sort of squeeze out from their mortgage books and whatnot. What else? Gold, typically very minimal impact. Remember, gold is more linked to the inflation, but the rate up or down doesn't really make too much difference. Crypto, you probably have seen what's happening with crypto. It's got a multi-factor sort of impact on it. Again, if you can get solid 3, 4, 5% interest out of your bank account, why would you take the risk on other assets. So that's basically their thought behind that. We've got Jeff here. Let's have a look. Jeff, let's see if this fits. RBA literally just gave a pay rise to savers, self-funded retirees, etc. The very people that are less likely to have a loan and who are spending. Average Joe can't afford rent and mortgage. Yeah, true. Yeah, like, again, the winners out of here are the savers because they can get a slightly higher interest rate. So yeah, but the mortgage holders, anyone who's in the market, we always say work on a slightly higher interest rate, irrespective of where you are in the timeline. So then you do have the capacity to jump on and still do the transaction at that point in time. Morning, Bob. Almost there, mate. You might have to rewatch some of it, but yeah, guys. So that's it in a nutshell. We did expect the rate rise last week. I sort of mentioned that. I'm expecting one more perhaps for this year, but got to look at the data, and that's what RBA uses to make the decision. So hopefully for everyone, we stay where we are and potentially drop down. But if we don't, then we just need to be prepared and have the right strategies in place. So I hope you enjoyed this podcast today, guys. And I'll see you all next week on Thursday. See you later, guys. Ciao.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.